Hello everyone, a very good evening. Good evening. So you are here even before me. Great. How are you all? Good evening, good evening. All right. So this is the first part of our final marathon. Please confirm the audio and video is fine. My voice is clear. I'm audible. Everything is okay. There's no disturbance in the video. I'm great. All right. So we are starting with the final marathon. We will cover all the five modules. Today we will try to volume is low. How about now? Is it better? Is it better? I'll try to speak as clearly as possible. If somewhere there's any problem, then please let me know. Hello, hi, good evening. All right, yes. So, hmm, we are first going to start with our module E. We will try to finish module C and module A as well, right? Then tomorrow we are going to cover module B and module D and then the MCQs from all the five modules. Today also we'll be practicing MCQs, some questions from the topics that we are covering, but we are starting with module E. All right? So I think we can start. Most of us are already here. Okay. So module E is the additional reading material on home loan, and we place it on the last in our priority list when we are studying for our RBWM paper. Still there are some topics like from unit 1 we have the unit 27 we have the different types of mortgages which are important. The meaning of check off facility is important. What is the difference between EMI and pre-EMI? So 2 3 topics from unit 27 we are going to cover. Then unit 28 is important, the housing finance and tax planning, the various sections under which we can claim deductions on our housing loan. That is there in unit 28. Then unit 29, mortgage advice, mostly it is theoretical. Although there are two topics, we have the time value and capital gains, and something which we also call as a reverse mortgage, which is there in our unit 30. So we have around 7 8 topics which are important from module E and that we are going to cover. So let us start. So we are starting with our module E. All right, so from unit 27, first we have the theoretical part, the lender's appraisal process. Whenever any customer applies for any loan, let's say a home loan, so there is certain process or steps that the bank follows. Right? Banks will collect the fees for processing, documentation, administration. They're now processing the application. They will collect the demographic, employment, financial details. To minimize the risk, the bank will check that the customer is not a fraud or blacklisted with any other bank or any other institution. So this is the information. The bank is trying to verify all the information. Bank is what? Bank is doing? Bank is verifying the information. So loan origination process starts, or it refers right from the time the customer walks into the bank with a request for the loan till the time the loan is finally and completely disbursed. All right, so starting from when a customer comes with a loan request and then finally the loan is disbursed. All of the stages they come under the loan origination. There are three phases: information acquisition, credit appraisal and sanction, and then disbursement. Information: where is the customer employed? What is the salary? Family income? Right? What are the expenses? do they have any other past credit history? We are trying to verify the information which is provided by the customer. We will verify the address, the phone number, documentary proofs of income, residence, age, all of these things are done, right? So what we are doing, we are confirming that the customer satisfies the basic norms and policies, and then we are seeing that incorrect decisions are not taking, otherwise it will increase our risk and it will add to the bad debts of the bank. So it is necessary to capture all the information. So this is the first step when we are verifying the information provided by the customer. Second phase is the credit appraisal and sanction. We will confirm that the customer satisfies the basic norms. We will apply the weighted risk-based credit scoring, right? And then on the basis of appraisal, we will decide what is the quantum of loan to be sanctioned to the customer. We will do the credit scoring, right? And we will try to make the most appropriate decision. And then the third phase is the final disbursement. Either a check for the sanctioned amount is issued, or the amount is transferred to the customer account, or direct payment to the supplier if, let's say, it is to purchase a car or a bike, right? So directly to the manufacturer or the supplier, the amount is transferred. So the amortization schedule is prepared. Repayment schedule is prepared. What will be the tenure? The EMIs, number of EMIs, interest rate, everything will be included in the amortization schedule. All right. So checking the documents, verifying the documents, preparation and procedure of the sanction, and then the final disbursement. All right. What all will be contained in the application form, the documents to be submitted for availing a home loans. These things we already know. These are very basic things that usually you won't find. Another important topic that has been asked in the previous examination is the application received through agent. Now, let's say the customer is not physically present. They are a citizen of India, but they are a non-resident Indian who are not available in the situation in India, but they want to get a home loan. So they can submit the housing loan application through their agents. So what they do, they appoint a power of attorney. Power of attorney. So this is also allowed. Authority is given in writing to another person to act for and on behalf of the person. So on behalf of the customer who is taking the loan, right? Now there are certain types of power of attorney that can be given to any other agent. We have a special power of attorney where the power of attorney is executed for a specific purpose, only for a specific act, right? Thus, the specific act is meant to imply either the specific act or acts related to each other, such as all the acts related or necessary to perfect a mortgage. All right, so one particular act or to accomplish one particular act, all the activities will be done by the special power of attorney. Then a power of attorney executed for the purpose of generally representing another person for more than one act is a general power of attorney. So now this agent is doing all the functions, all the activities on behalf of the principal. So there's the agent principal relationship when we are talking about a power of attorney. So who is the principal? Principal is the person who is, let's say here, the non-resident Indian, and agent is the person who has been given the power of attorney. The power of attorney can also be executed in favor of more than one person. So a question can be framed in this manner. Which of the following statements are true about the power of attorney, where the application is received through agent? So you should remember special power of attorney, general power of attorney, and it can be created in favor of more than one persons as well. All right. And a general power of attorney will continue until expressly or impliedly stated otherwise, until revoked or determined by the death of either of the parties. Right? So the general power of attorney will continue until and unless the contract is revoked by either of the parties, either the principal or the agent. But the special power of attorney, their power of attorney will end once the act is done. So once the act for which they have been given the responsibility it is done, then it will be automatically ended. If, let's say, a power of attorney is executed in a foreign country, then it should be stamped within 3 months of its being received in India. If it is not stamped within the period of 3 months, then it will be deemed to be unstamped and it cannot be executed or acted upon. All right. So, power of attorney can be accepted for creation of a mortgage, right? Both the principal and agent, when they are agreeing that okay, now the agent will act on my behalf, they will make the application, submit the documents, they will give the bank all the information for verifying the documents, everything. All right, so the latest document like sale deed will be there, all the survey will be conducted, so residence verification will be done, everything will be provided by the power of attorney. Okay, so it will be verified as to the necessity for the power of attorney. When, let's say, both the principal and the agent are residing in the same place, then the power of attorney may not be required except in case of property developers. All right, so it will depend on the bank. Good evening. So it will depend on the bank whether they are accepting the customer's request for a power of attorney or not. All right. So when a mortgage is to be created, the branch will obtain the title opinion from the panel advocate. The same things will be followed. The schedule of the property should be fully described. Survey number should be given, street door number, locality, extent, boundaries. These are very theoretical, basic things. You can just go through them. All right. So now the principal will agree that all the acts, deeds, things lawfully done will be the act of the principal. Whenever an agent is acting on behalf of the principal, it is meaning that it is actually done by the principal. Whatever the principal is legally capable of doing, the agent will also do. All right. Then what else do we have? We have the appraisal form for a home loan. Eligibility, the lender will give a, they should have a policy laying down the criteria for the acceptance of a home loan exposure, right? They will have their own criteria, the parameters. Okay, right. So interest, the bank will decide what is the interest to be offered. Insurance, the house or the flat should be insured. Moratorium, we already know it is a repayment holiday, right? 18 months after the first disbursement or 2 months after the completion or construction of the house, whichever falls first. If, let's say, if the loan under consideration is for the purchase of land, then the maximum holiday is only 3 months. These things we have already seen. Now, the difference between EMI and pre-EMI is important. We already know what is equated monthly installment. It is the interest over the period of the loan at the reducing balance calculated and added to the loan amount to arrive at the total payable amount. What is EMI? EMI is the interest we pay after the loan has been disbursed, right? And it includes both the principal as well as the interest, right? But when we are talking about the pre-EMI, pre-EMI is a temporary phase where we only pay the interest on the disbursed amount. Full EMI includes both principal and the interest payment, but pre-EMI is calculated only on the disbursed amount. So pre-EMI will start during the loan disbursement phase and the EMI will become after the entire loan has been disbursed and the construction is complete, right? So the pre-EMI will cover only the interest on the disbursed amount, the loan that has been given. Full EMI will include both interest as well as the principal repayments. Principal repayment will not start in the pre-EMI. It will start only after the whole amount has been disbursed. All right, so this is the difference between the two. So until the final disbursement and the repayment commences, the borrower pays interest only on the portion of the loan that is disbursed in installments. This is known as the pre-EMI interest. So it is a monthly simple interest on the amount that has been disbursed by the bank already. Okay. So let's say the home loan sanctioned to Mr. Raju is 10 lakh at the interest of 10% per annum. The bank has disbursed 2 lakh towards the first phase of construction. So in the pre-EMI, the customer, Mr. Raju, will pay interest only on the 2 lakh, not on the complete 10 lakh. All right. So how do we calculate it? P into R into T. So 2 lakh multiplied by 10 divided by 100 to get it into the absolute number and divided by 12. So this is the pre-EMI. All right. So pre-EMI is paid only on the amount that has been disbursed by the bank, and EMI is paid after the full disbursement. So the principal repayment also includes here. But in the EMI, only the interest is paid. Then we have another concept which is EMI reset. Now, let's say due to any temporary reason, the customer is unable to make the EMI repayment. They're requesting the bank that I want more time. So what does the bank do? The lender will not usually change the EMI amount. The EMI amount will not be changed. The number of installments is increased or reduced depending upon the change in the total dues. Now, this is one situation. Another situation, in a floating rate interest home loan, the total dues of the lender will change when the interest rate is changed. What happens in a floating rate? Now, mostly all the loans are given on floating rate only. So, if the floating rate interest changes, the total dues will also change. So, the EMI will have to be adjusted. So, how do we adjust it? We do not change the EMI amount, rather, we increase the EMI, total EMIs that have to be paid if the floating rate reduces, or we increase it accordingly if it increases. Okay. Then another important concept is the check-off facility. This also we know. Let's say I am requesting my bank that from my salary directly you can cut the EMI. That is simply the check-off facility. So in the case of salaried persons, a check-off arrangement should be pursued. So this is an irrevocable letter of authority from the borrowers. The borrower gives this authority to their lender for deducting a specific amount of monthly installment from her salary or wages. All right. So I am the borrower. I'm giving this authority to my creditor, the bank, that whenever I'm getting my salary, my payment in my bank account, you can do what? You can deduct a specific amount of the monthly installments. So this is an irrevocable letter. That means it cannot be revoked. This authority for making payment of the dues to the lender out of any amount payable to the employee, terminal benefits in case of her or his retirement, resignation, discontinuance of service, or death. Okay. So, an undertaking from the employer to obtain a clearance from the bank before settling the dues is also to be taken, right? So, this is possible only if the salary is paid through a bank, not if it is paid in cash, right? The lender needs to keep him informed of the changes in the employment situation of the customer. In case we are talking about government officers who are themselves drawing and disbursing the authorities, who themselves are the drawing and disbursing authorities, and they take housing loans, then a letter of understanding is sufficient. All right, again, no need to go into detail. Basically, we will remember these points, that it is an irrevocable letter of authority from the borrowers for deducting a specific amount, and this irrevocable authority for making payments of dues to the lender, it is payable to the employee, the terminal benefits, whatever the case may be. All right, these three concepts that we have studied, these are clear. The lender appraisal process, then the pre-EMI, EMI, and the check-off facility. This is clear. So now let us try to solve some questions based on this topic. Yes, these questions are based only on the topics that we have covered so far. Okay. So which of the following are methods used by banks to minimize risk in the loan origination? Requesting co-borrowers or guarantors, charging fees for processing and documentation, conducting a thorough credit appraisal, verifying the authenticity of the customer's information. So, if the bank wants to reduce or minimize the credit risk, what steps can the bank take? 1 and 2, 2, 3 and 4, 1 and 3, or 1, 3 and 4? D. D is 1, 3 and 4. Okay, others also answer. D, D, yes. Correct. Hmm. The correct answer is D. Charging fees for processing and documentation, this will not minimize the risk. All right. D is correct. Great. Next question. Which of the following statements accurately describe the EMI? EMI includes both principal repayment and interest on the loan. EMI is calculated by dividing the total payable amount by the number of installments. EMI payment begins the moment the first loan disbursement is made. EMI is always calculated on a simple interest basis. So which statements are correct? 1, 2 and 3, 1 and 2, 3 and 4, or 2, 3 and 4? Which statements are correct? B, 1 and 2. Okay. B, hmm, yes. So statement 3 is incorrect because the EMI payment begins after the complete disbursement has been made. And statement 4 is incorrect. Why? Because it is not always on the simple interest basis, rather reducing balance. All right? No, not A, Sharmila, it is B. The correct answer is B. All right? Yes, 1 and 2 is correct. Next, what are some of the key documents and verifications required to ensure the borrower holds clear and marketable title to the property? Sale deed, agreement of or agreement of sale and non-encumbrance certificate, parent document showing how the transferor acquired the title, proof of recent property valuation and RERA approval of housing projects, personal guarantees and character certificates of the borrower. Again, very simple. This topic was not in the theoretical part, but I know that you will answer it correctly. How are we going to verify that the borrower has a clear and marketable title to the property? So which statements are correct? 1, 2 and 3, 2 and 4, 1 and 3, or 2, 3 and 4? A, A, yes, correct. Personal guarantees and character certificates of the borrowers. This will not help us verify that the borrower has a clear title or not. Okay, so certain documents related to the loan, list of security documents related to the loan, promissory note, let's say, agreement of guarantee from the guarantors for the loan, it will be required, letter authorizing the bank to dispose the proceeds of loan, stamped letter, let's say if it is a company, so the stamped letter, right? Documents relating to a house property, sale deeds, then encumbrance certificate for 13 years, approved building plan, license or permit for construction, letter of allotment from the housing board, possession certificate, payment receipts, registration receipts, these things. And if let's say we are taking loan in case of a second mortgage, right? So letter from the borrower to the bank who is now giving the mortgage for extending the earlier mortgage to secure the bank, right? Letter to be addressed by the prior mortgagee to the subsequent mortgagee, right? Letter from the first charge holder addressed to the second charge holder. So these are the documents that are related. Okay. Pre-EMI interest refers to the interest paid only on the disbursed portion of the loan before full repayment begins. The interest component calculated on a reducing balance basis before EMI payment starts. A monthly simple interest charged on the disbursed portion of the loan. A penalty for delayed loan repayment. So what is a pre-EMI interest? Which of the following statements will be correct? 1, 2 and 3, 2 and 4, 1 and 3, or 2, 3 and 4? C, 1 and 3. All right. A, 1, 2 and 3. Statement 2 says that the interest is calculated on a reducing basis. Statement 3 says a simple interest is charged. No, don't get confused. How can both statement 2 and 3 be correct together? The last part of statement 2 is right before the EMI payment start. But the interest component calculated on a reducing balance basis. This is not a point. The correct answer was C only. Hema, you were right. 1 and 3. 1 and 3. Interest paid only on the disbursed portion of the loan before the full repayment begins, and a monthly simple interest charged on the disbursed portion. Alright, the second statement is incorrect because of this part. Interest component calculated on a reducing balance. Alright, so 1 and 3. The correct option is C. Okay. Next, which of the following are the key elements of a check-off arrangement for salaried borrowers? An irrevocable letter of authority for deducting the monthly installments, permission from the lender to modify the repayment terms at will, authority for payment of dues from terminal benefits upon retirement, resignation, or death, a mandatory insurance requirement for the borrower. So, what is required in a check-off facility? A check-off facility. Again, 1, 2, and 3, 2 and 4, 1 and 3, or 2, 3, and 4. C. Others also please answer. C. Yes. C is correct. 1 and 3. We have already seen the features of the check-off facility. Correct. Okay. Which of the following is not a type of power of attorney relevant in the context of housing loan application? Special power of attorney for specific judicial transactions, general power of attorney for representing or performing more than one act, springing power of attorney for some specific events, irrevocable power of attorney specially for the mortgage creation. So, which is not a type? We have studied mainly two names were there and then another type was there. All the three we have given in the notes. Which is not a type of power of attorney? C, yes. Springing power of attorney, this is not there. Special power of attorney for specific acts, general for more than one, and when we are talking about the mortgage creation, then it is a irrevocable power of attorney until any one of the party uh, dies or the contract ends. Okay. Questions? I think yes. That was all from the topics that we have covered so far. Now we are starting with a new topic, which is the mortgage. Mortgage. What is mortgage? A transfer of an interest in the specific immovable property. First point, mortgage is created on the immovable property. For what? For the purpose of security, for payment of money advanced or to be advanced by the way of loan. An existing or future debt. Another important point. Mortgage can be created for an existing or for a future debt as well. All right, and it may give rise to a particular liability. All right, now we have in our module B studied about the SARFAESI Act. So when the banks they want to recover their loans without court intervention, they can use the provisions of the SARFAESI Act. All right. So the mortgage bank is entitled to receive the rent from the lessee as well. So if let's say it is a lessee-lesser relationship, so this is also allowed. Again, need not we need not go into detail of this, but the meaning of mortgage is important. All right. Now we have different types of mortgage. Basically, six types of mortgage can be created. A simple registered mortgage is there. Then we have a conditional mortgage, equitable mortgage is there, English mortgage is there, then we have the anomalous mortgage and conditional mortgage. Okay, but mostly the most important types are the simple registered and the mortgage by deposit of title deeds or equitable mortgage. So what is a simple mortgage? Some points that you need to remember. Without delivering possession, without delivering possession of the mortgaged property, the mortgager binds himself personally. What is the meaning of personal? If let's say the property that was kept as mortgage values currently at 10 lakh rupees, but the loan that was taken by the customer was of 15 lakh rupees. So the remaining 5 lakhs, the lender, the creditor has the right to recover this remaining 5 lakhs from the borrower. All right. So the delivery possession is not passed. The borrower can use the property if let's say it is a house, so they can continue to reside in the house. So without delivering possession of the mortgaged property, the mortgager binds himself personally to pay the mortgage money, and they agree that in the event of his failing to pay accordingly, the mortgagee shall have the right to cause the mortgage property to be sold. Now the person who is taking the loan is known as the mortgager. They are keeping their property as a security. and the creditor is known as the mortgagee. Here the bank is the mortgagee and the borrower is the mortgager. Mortgaged property is there. Mortgage money includes both the principal and the interest, mortgage money. And mortgage deed is the agreement signed between the borrower and the creditor. All right. If let's say the property is sold at 10 lakh rupees and the loan was not of 15 lakhs, let's say the loan was just of rupees, let's say 7 lakhs. So the remaining 3 lakhs will now be returned to the borrower. All right. So in the event the property generates more than what was the loan amount, then it will be given back to the borrower. All right. So this is the simple mortgage. Then second type of mortgage is what? Let's say I am living in Mumbai, right? I have a house located anywhere else. Let's say I have a house that is located in Chandigarh. I want to keep this property as a mortgage. Now here also the physical property is not present. What will I do? I will deposit the title deeds. The title deeds, right? And this is known as an equitable mortgage. It is a very strong type of mortgage. So where a person in any of the following towns, Kolkata, Chennai and Mumbai. Yes, sorry about that. Okay. So when the person is in any of the towns, let's say Kolkata, Chennai and Mumbai, or any other town which the state government will notify in the official gazette. So they are doing what? They are delivering a creditor or his agent the documents of title to immovable property. Simple mortgage is nothing. We are not delivering the possession of the goods to the mortgager. We are saying that I am personally liable to pay the debt. If I do not pay the debt, then you can sue me and you can take the property and sell it in the market and recover your dues. Simple. Simple mortgage. No complications here. All right? No complications. So the institute will ask you which of the following are characteristics of the simple or registered mortgage, right? So is there a possession of goods? No. The property is not delivered to the mortgagee. Only we will say constructively it is there. Is there a personal liability to pay? Yes. What happens in the event of failing to pay according to the contract? The mortgagee will have to will have the right to cause the mortgage property to be sold. No, the title deed is also not given. The title deed is also not given. All right. We are just registering the mortgage. The document titles are not to be given in the possession of the mortgagee. We are just writing this down that in the case of the failure of payment, then we can sell the property. Okay. The agreement of the simple mortgage just says that, okay, clear now? Clear? Okay. All right. Yes. So in the deposit of title deeds, equitable mortgage, we have to keep the title deeds with the creditor, the lender, or the mortgagee. Okay. So what are the characteristics of a mortgage by deposit of title deeds? There must be a debt. Debt can be existing or in future. There must be a deposit of document of title. So a second mortgage cannot be created, right? A copy of the title deeds cannot be given. The original title deeds are to be kept with the mortgagee. The deposit must be in one of the notified towns, Kolkata, Mumbai, Chennai, or any other town which is notified not by the state central government but by the state government. Then the deposit must be made by the mortgager or by the agent as well. The intention should be to create a security for the debt, not for safekeeping or any other purpose. And the letter of intent should be obtained. That is the mortgage by deposit of title deeds. All right. Then the mortgagee will have the same rights under the equitable and registered mortgage. Registered mortgage is another name for the simple mortgage. Another name for the registered mortgage is simple mortgage. Another name for the deposit of title deeds is the equitable mortgage. Right? So an equitable mortgage will have priority over the subsequent registered mortgage. Now, what is the meaning of priority? Here we are talking about the charge being registered with the central registry. This we will cover in the further slides as well. Central registry. So now the bank who is giving the loan and getting the charge registered becomes the secured creditor. Secured creditor. And whenever there is a sale of the property, the receipts will be first used to pay off the debt of the secured creditor, and then the unsecured creditor will come in line. All right. So the equitable mortgage will remain valid as long as the mortgagee retains the title deeds. If the mortgagee parts with the possession, the mortgage will stand extinguished. It means that if the title deeds are lost, then the mortgage will also stand extinguished. But let's say the mortgagee had given the title deeds to any valuer or to, let's say, any lawyer for getting their legal opinion. Here, the mortgage will not be lost. We are not parting, but we are giving it for some particular use. The mortgagee still has the right to the title deeds. All right. Okay. Then what are the rights available? What is the difference between the simple mortgage and an equitable mortgage? Is there a transfer of possession? No. The physical transfer of the possession is not there in simple mortgage nor in equitable mortgage. Is there a right to sue for personal liability? Yes. That is, if any amount remains unpayable after the sale of the property, the borrower can be sued for paying the remaining amount. So it is there in both. Is there a right to sue for the sale of mortgage property? Again, yes. Right for foreclosure. Now, what is foreclosure? Foreclosure means now the borrower cannot reclaim or redeem the property. The right of foreclosure is to be filed within 30 years. So there is no right for foreclosure. The bank cannot file a suit that now the customer cannot reclaim the property. Can they sell without court's permission? No. Both the mortgage for selling the property, they have to take the court decree. Now, this was before SARFAESI. Before SARFAESI. All right. After SARFAESI, we can directly start the proceedings and sell the property. Can they enjoy income out of the mortgage property? Again, no. Let's say the property that has been kept on mortgage is a rented property. The owner is not living in the house, someone else, the tenants are living and they're paying the rent. or let's say it is any commercial building and profits are being generated, the bank or the creditor will not have any claim on the rent or the profit generated from the mortgaged property. They cannot enjoy income out of the mortgaged property. Can they appoint a receiver without court's permission? Again, no. And this was also there before the SARFAESI Act came into force. All right. So this is the registered simple mortgage and deposit of title deeds or equitable mortgage. Now, we said that there is no right to sue for foreclosure in both simple and equitable mortgage. There's another type of mortgage which is the mortgage by conditional sale. Now, what does the mortgager do? They sell the property to the creditor. There's an actual sale of the property. So now here what is happening? The possession is transferred. In the previous two, there was no delivery of possession, but here the legal possession is given to the creditor. All right. But there's a condition. This type of sale is an ostensible sale. Ostensible. It means that if the borrower pays the debt, then the sale will become void. If the borrower defaults on the debt, then the sale will become absolute. So in this case, the property will be returned to the borrower, and in this case of the default, now the bank will become the absolute owner of the property. All right. So that is the mortgage by the way of conditional sale. Okay. So the mortgage has the right to sue for a decree for the court and get the borrower debarred forever to get the mortgage property back. So this is the right to foreclosure. If the borrower does not pay the loan amount and they also do not, or let's say they have made the sale, they're not making a reclaim to the property within 30 years. So now within 30 years, the bank can file a suit in the court for foreclosure. Now the customer cannot come and claim the property. Right. So within 30 years from the day the mortgage money becomes due. When the borrower defaults on the payment within 30 days, the bank can file a suit for foreclosure, and now the uh, borrower will lose their right to reclaim the property. That is the mortgage by conditional sale. So a sale is done, ostensible sale. If the loan is paid back, sale will become void. If it is defaulted, sale will become absolute, and there's the right to foreclosure. All right. Now, when we talk about the priority of charge, wherever a mortgager creates more than one equitable mortgage over the same property in favor of two financial institutions. The institution in whose favor the mortgage is created first will have priority. Let's say a house is owned by Mr. X. They created a mortgage by submitting the title deeds to Bank A. This was done in 2017. Then to Bank B, they also created a equitable mortgage by giving the copy. They said that I have lost the original copy, the original titles, I'm giving you the copy. This was done in 2022. But Bank A, or let's say Bank A was given the copy. Let us make it simple. So Mr. X from Bank a copy was given and loan was taken on the equitable mortgage in 2017. Then Bank B, loan was given again on the title deeds in 2022. But this Bank A forgot or decided not to get the charge registered. So they did not get the charge registered. In the case of Bank B, they got the charge registered. So what will happen if Mr. X defaults on both of their loans and this property? The house is taken to be sold in the market. Then the proceeds that are generated will be used to pay the debts of Bank B first. Although the loan was given by Bank A first in 2017, still, who will have a priority? Bank B. Only in exceptional cases. Only in exceptional cases. If, let's say, the borrower they prove that they have lost the original title and it is a true copy, then the bank might accept, but it is advised to accept the original title only. That is why I said the bank A accepted the copy. All right. Although the equitable mortgage says that you have to take the original title only, title documents only. Okay. All right. Then what else? What else? When a mortgager has created separate registered mortgage in favor of two or more, reference to the date of the execution of deeds has to be made. Again, same thing. Charge that gets registered first will be given priority. The priority of charge will be determined with the reference of date of deposit of title deeds. All right, all right. The equitable mortgage in no way gives inferior rights compared to a registered mortgage. There are other types of mortgages as well, but they're not given in your syllabus. Basically, two have been discussed, registered and equitable. Right? Other types of mortgages are there. Like we said that bank will have no right over the rent and property of the rent and profits of the property. The bank, there's a type of mortgage which is a usufructuary mortgage. There the bank will have a right to collect the rent and profit, but it is not given, so we will forget it. Then where do the bank have to get the charge registered? With the central registry. Under the SARFAESI Act, the central registry is the SARSAI, Central Registry of Securitization and Asset Reconstruction and Security Interest of India. It became functional from 31st of March 2011. So the all the types of um, making of the charges, so registration of charge has to be made with the SARSAI. Any modification in the terms and conditions has to be made with the SARSAI. Any satisfaction of the charge again has to be registered with the SARSAI. All right. This SARSAI will have a central registrar who will maintain a central register. Any person, borrower, lender, government, they can pay a fees and they can check the credentials given in the register. Any person is allowed to check it. Okay, so the transaction secured by the movable property and intangible assets can also be filed with the SARSAI. It is compulsory to file all the creation of mortgage. That is compulsory. If the financial institution or bank wants, then they can also file their movable or intangible securities with the SARSAI. That is also allowed. All right. So, any person can also search and inspect the records maintained by the registry on the payment of fees prescribed under the rules. Okay, the registration will be made online within 30 days of creation of the equitable mortgage. More time can be given, but up to 60 days only. Now, there's a whole process. If you do not get the charge registered within, if you get it registered within 30 days, you have to pay a normal fees, right? Beyond 30 days to 60 days, some additional fees has to be paid. 60 days to 120 days, more fees has to be paid. But now more than 120 days, you cannot get the charge registered. This amendment was made in 2019 rules. So along with the fees, you have to get the charge registered. Okay, done with mortgage part. Now let us answer some questions. What are the key characteristics of mortgage advice profession in India as it currently stands? It is heavily regulated by the government. There's a strict code of conduct mandated by the law. There are no entry barriers to the profession. Mandatory licensing is required for all the practitioners. So if anyone has wants to carry the mortgage advice business, which of the following is correct? Yes. What should be the correct answer? D. Mandatory licensing is required for all practitioners. Jagat, yes. Have you just joined? No, you had commented before also. Actually, no. This mortgage advice profession in India is not a formal profession. All right, it is not a formal profession and it can be carried out without any regulation. There is no entry barrier, no code of conduct or ethics which is stipulated by any regulation. So any person can enter the profession and they can provide advice and do the mortgage advice business. All right. So there are no entry barriers to the profession. 7 baje na class. No, today the class was from 6 p.m. It was from 6 p.m. Tomorrow also, because we are having the final marathon, so it is from 6 p.m. All right. So there are no rules and regulations. It is not a formal or regulated profession. Anyone can enter and participate. Okay. Not clear. Nothing. Just three things. In India, the mortgage advice profession is carried out without any regulation. Like portfolio management is a regulated business, mutual fund is a regulated business, but mortgage advice is still not regulated by RBI or any other institute. Right? No regulations are there. It is a highly unprofessional business, we'll say, in India. In other nations like UK, US, they have regulations for the mortgage advice services, but not in India. So anyone can enter the market. They can say that I am a mortgage advisor and I will give you professional advice. There's no restriction on that. There are no legal provisions. Okay. Now answer this question. Which of the following is not an essential requirement for creating a mortgage by deposit of title deeds? There must be a debt existing or future. Deposits of documents of title is one in one of the notified towns. Intent to create a security for the debt and obtaining a letter of intent. Mortgagee's right to sell the property without court's intervention. So yes, everyone is answering correctly. The correct answer is D. What are the notified towns? Mumbai, Kolkata, and Chennai. Right? So the person should be present here. Property can be located anywhere. All right. property can be located anywhere in India. The deposit of documents of title should be in one of the notified towns. No, not B, but the correct answer is D. All right. Next, who can access and inspect the records maintained by Sarsai? This also we have covered. Only government officials and authorized bank personnel, any person upon payment of the prescribed fees, exclusive to parties involved in the registered transactions, financial analysts, and market researchers. Who is allowed? Hmm. B. Any person. Any person can go and check the records. So if a charge has been created on a property or not, it is encumbered or not, right? Modification of charge, satisfaction of charge, any person can go and check the records. All right. What type of property is excluded from the provisions of the SARFAESI Act? Also, very simple. Urban residential property, security interests created in agricultural land, commercial office space, and personal vehicles. So, what type of property we cannot create a mortgage on? Correct. We can create a mortgage, we cannot take it to the SARFAESI Act. So, it is a security interest created in agricultural land. Absolutely. Okay. Under a mortgage by a way of conditional sale, which of the following statements are true? The sale becomes void on repayment of the mortgage money. The mortgagee can look to other properties of the mortgager for repayment. The sale shall become absolute upon the non-payment and a court decree in favor of the mortgage. Bankers prefer this type of mortgage due to its simplicity. So we have studied two main points about the conditional sale. Just answer it. Only those 2 points are correct. So, which type of sales occurs in the conditional sale, mortgage by conditional sale, and ostensible sale? Ostensible sale, which means the property is sold to the mortgagee. I'm getting mixed responses. B, A, B, B, 2 and 4. Which of the following statements are true? You need to answer which of the following statements are true. You are saying B. 2 and 4 are incorrect. The correct answer is A, 1 and 3. So, what did we study? Ostensible sale means if the borrower makes the payment is done, then the sale will become void. The bank will have to return the property back to the borrower, right? And if the borrower makes a default, they do not pay back the debt, then the sale will become absolute. So now the mortgagee, the bank will have absolute right. Yes, so the correct answer is A, not B. Clear? And it is not simple. Why? Because the bank has no surety whether they will be the owner, absolute owner or not. So it is not simple. And they also cannot look to other properties of the mortgager for the repayment. Alright, so only 1 and 3 are correct. A. Okay. Now we come to the next unit, which is unit 28, Housing Finance and Tax Planning. So in this chapter, which is again completely theoretical, what you need to study is the different types of sections available in my Income Tax Act where I can claim the deduction. So these are the home loan tax benefits. Home loan tax benefits. So we'll be covering section 24, section 80C, section 80EE. All right. So let us go to the theoretical part. In respect of loan taken for the purchase, construction, or repair of residential unit, the borrower can claim benefit of payment of interest as well as the repayment of principal. So what is the tax benefit under section 24? The interest on housing loan can be claimed as a deduction. So here we can claim a deduction on the interest. All right. Interest that I'm paying on my housing loan from the income from property, salary, business profession. Maximum that I can claim is 2 lakh rupees. All the points that I have highlighted, you need to remember them. This is also going to help you for the unit in which we have covered the tax part, right? In module D. All right. So, interest on housing loan can be claimed as a deduction, maximum up to rupees 2 lakhs. What are the conditions to be fulfilled? The loan should have been taken on or after 1st April 1999. Why? Need not worry, just remember the points. Only for the loans that have been taken after 1999, 1st April, loan is for the purchase or construction of a residential property or refinance of the principal amount. All right. Second, another very important point, the construction should be completed within 5 years of raising the loan. So we have done the scenario type questions. The loan was taken for the construction of a house, but it was not completed within 5 years. Can now the individual claim the deduction? So, no. Also, only after the construction is complete, then you can claim the deduction. Deduction can be claimed only from the financial year when the purchase or the construction is completed. Under construction, not allowed. So the lender issues a certificate at the end of the financial year. The lender will mention the interest and the principal paid during the year, and the interest can be taken for the deduction can be claimed for the interest payment of home loan for a self occupied property. All right. Also, this is for the construction or purchase of the property. If, let's say, the loan is availed for the repair or renewal, then the amount that is allowed is only 30,000 rupees. Construction or purchase, rupees 2 lakhs. Repair or renewal, 30,000. In case, in case the property for which the home loan has been taken is not self-occupied, it is rented, then no maximum limit for tax deduction has been prescribed, and the taxpayer can take the deduction on the whole interest amount. So just remember all of these points. Okay, construction and purchase of the property, 2 lakhs maximum deduction, interest that is paid on it, the home loan. Then once the construction is completed, only then you can claim the deduction. Also, construction or the purchase should be completed within 5 years of taking the loan. It can be taken for a self-occupied property. Repair or renewal amount is 30,000 rupees. If not self-occupied, then there is no maximum amount. All right. What else? If let's say the property is not constructed or completed within 5 years from the financial year in which the loan was taken, then the tax benefit will not become zero. It will be reduced to 30,000 rupees. All right. It will be reduced from 2 lakhs to 30,000 rupees. Okay. What else? The deduction for the interest is allowed in 5 equal installments, starting from the year in which the house is purchased or the construction is completed. Although pre-construction interest is also allowed to be claimed. All right? Okay. If let's say the income from the house property in the case of the self-occupied property will be zero or negative to the extent of the interest on the housing loan, right? So just 2 3 points that are important are given in this slide that you need to remember. Okay, this was section 24 where I can claim the deductions on the interest paid on home loan. What about the principal? So the tax benefit on home loan principal repayment is allowed under section 80C. What is the maximum tax deduction allowed? 1,50,000. It is availed for both self-occupied and let-out property, maximum up to 1.5 lakhs, right? This tax deduction is also part of the various deductions which are allowed under section 80C. In the module D, we have studied about the different parts or schemes under which I can claim deductions under section 80C. So it will also include the PPF account, tax saving fixed deposit, life insurance premium, NSC, senior citizen saving scheme, Sukanya Samriddhi Yojana, everything that we have covered. So it will form a part of it together. Then the tax deduction is available on payment basis. It does not depend on the year for which the payment has been made. Amount paid as stamp duty, registration fee is also allowed. So like I said, completely theoretical, right? You need to remember the conditions. Only if these conditions are fulfilled, then you can claim the deduction. From here, scenario type questions will be asked, right? So they will give you one condition which is not fulfilled and they will ask you whether or not this individual can claim deduction under section 80C. So you need to remember the conditions. What are the conditions? The deduction will be allowed only if the construction of the property is complete and the individual has received a completion certificate. No deduction will be allowed for the years during which the property was under construction, although principal repayment would have been done, but here deduction will not be allowed. Deduction is available whether the property is self-occupied or let out, and it can also be claimed for more than one house property. This is important. Okay, not just for one house, but if you are taking a loan for second house, that also is allowed. Then if let's say I have purchased the house, but I sell it off within a period of 5 years. Then what will happen? Reversal of tax benefits. If a house property for which the tax benefit was availed is sold within a period of 5 years, then the property which has been received, what will happen then? The tax benefit under section 80C will not be eligible for claim in the financial year, plus already the amount that you have claimed, you will have to pay tax on it. So the total amount of tax deduction already claimed shall be deemed to be income of the property and it will be liable to pay tax on that income. So the reversal of tax benefits will happen when if the house property is sold within a period of 5 years. This is there in section 80C. And then we have the tax benefit under section 80EE, which is the deduction for the first time home buyers. All right. So the deduction here is also available on the interest paid on the home loan, but it is only available to the first time home buyer. So second housing is not allowed. What is the quantum of deduction? 50,000 for the interest paid. Deduction is available over and above of section 24 and 80C, right? Over and above. So if you have already claimed deduction under these sections, then also you can claim deduction under section 80EE. All right. Then the conditions to be fulfilled. Deduction can be availed on the loans that have been taken only in the financial year 1st April to 31st March. The property Value of the property should not be more than 50 lakh rupees. Loan amount should not exceed 35 lakh rupees. Amount of claim deducted under this section will not be eligible to claim under section 24 again. All right. Benefit will be claimed till the repayment of the loan continues. It will be applicable for the first house property. Here, it can be either self occupied or rented out, let out, and on the date of the sanction of the loan, no other house should be owned by you. So, only on the first house. All right, these are the conditions. Then, the individual can claim benefits whether the house is purchased singly or jointly. So it is both the people can claim the deductions. It is a per person basis instead of a per property basis. So let's say a husband and wife have purchased the property jointly and both of them are paying installments. Let's say half half. Then both of them can individually claim this deduction. So this is applicable on per person basis instead of a per property basis. And it is not necessary to reside in the property for which you want to claim this deduction. Okay. Yes. Then we need to calculate the gross annual value of the property. These points are not that important. Just the conditions for each of the sections is important. Just give me a second. Yes, so like I was saying, if let's say both the people who have jointly acquired the property, then each co-applicant can claim a maximum tax rebate of 1.50 lakh for the principal repayment and 2 lakh for the interest payment. So that is also available on a per person basis. All right. Yes, so a joint loan can give more tax benefits. What about NRI? If let's say a non-resident Indian has taken a home loan, can they avail the tax benefit? Yes. So, like in the case of a resident Indian can avail a tax benefit of repayment up to 1.5 lakhs on the principal component and 2 lakhs on the interest component. An NRI who repays the home loan is also eligible for the tax rebate, right? So if a question is asked, can an NRI be eligible for tax rebate? So yes, under the same sections as per the resident. Okay. Also, let's say in case the salary earned abroad is the only source of income, then an NRI will not have the opportunity to claim the tax exemption. Why? Because the salary is not taxable in India, then why would they be allowed to claim the deduction? Only if they are NRI, but they're also earning some income from India and they're paying tax to the Indian government, right? In case the NRI earns an additional taxable income in India, apart from the salary abroad, he is eligible to claim the tax exemption from the home loan repayment, which is available to the resident loan. All right. Okay. Now let us answer some questions based on these topics. Who is eligible to claim deductions under Section 80EE? Only individual taxpayers purchasing the property singly, individual taxpayers purchasing the property either singly or jointly, corporate entities purchasing residential property, individuals renting the property that they own. So Section 80EE can be claimed by. B, yes, this we have already seen. Individual who is purchasing the property, individual taxpayers. So here the deduction can be claimed on a per person basis and not a per property basis. So either singly or jointly. Okay, next. B is correct. Under Section 80C of the Income Tax Act 1961, in the context of home loans, which of the following is or are eligible for tax deduction? Section 80C. Repayment of the principal amount, payment of registration fees and stamp duty, payment of home loan interest, prepayment penalty on home loan. So, what can an individual claim under the Section 80C? C, C, C. Correct. 1 and 2. Great. And not just today. Please remember all of these conditions for your exam as well. All right. Please remember these. Download the PDF, go through the notes, and revise thoroughly. Okay. Which conditions must be satisfied to claim deductions under Section 80C for principal repayment? Property must be self-occupied. Construction of property must be complete. Property should not be sold within 5 years of possession. Deduction is available only after receiving a completion certificate. So, which statements are correct? Should the property be self-occupied? Is it B, 2 and 4? D. Property should not be sold within 5 years of possession. This should also be true. So the correct answer will be what? Will be D. Yes, it will not be B, it will be D. Right? It will be D. Hmm. Right? So it will be D. Correct. 2, 3, and 4. Property can be E. Which conditions are necessary for claiming deduction for the first time home buyers? Loan sanctioned only between 1st April to 31st March in the financial year. Value of property less than 50 lakh rupees. Home loan amount not exceeding 35 lakhs. And the property must be self-occupied. Which statements are correct about the section 80EE? A, D, D. Hmm. The correct answer is A, 1, 2, and 3. Yes, A is correct. Property must be self-occupied. This is not true. It can be a self-occupied or it can be rented out as well. All right, but the value of the property should be less than 50 lakhs. The amount of loan should not exceed 35 lakhs and the loans should be sanctioned in the financial year. Not D, not D. The correct answer is A. Fourth statement is not correct. Both for self-occupied and rented out. Any property can be eligible. All right. How is Section 80EE applicable in the case of joint property ownership? Deduction is applicable on a per property basis. Deduction is applicable on a per person basis. Only one of the joint owners can claim the deduction. Joint owners cannot claim deduction if they are staying in the rented accommodation. Yes, very simple. Huh, B. Applicable on a per person basis. So if let's say two people have jointly purchased the property, they have taken the loan, both of them are making the payment of the interest, right? Both of them can individually claim the benefit. So this is the benefit of taking a joint loan. Okay. In the case of a let out property, how is the deduction for interest on borrowed capital treated? It is limited to 2 lakhs, it is limited to 30,000. There is no upper limit. We are talking about a let out property. No, we have not yet received the correct answer. Let out property. If the loan is taken for a construction or purchase of property, then it is 2 lakhs, right? If the loan is taken for the repair or renewal of the property, then it is 30,000. And if it is a let out property, then the entire interest can be allowed for the deduction. So there is no upper limit on the deduction amount. All right. There is no upper limit. The correct answer is B. We just covered it, right? If the loan is availed for the repair or renewal, an amount of 30,000 is allowed. If the interest on housing loan is to be claimed on a deduction from the income from property, maximum of 2 lakh rupees for the purchase or construction. And if the income from house property in the case of a self-occupied property will be zero, or if it is a let out property, then there is no maximum limit to it. All right. In case the property for which the home loan has been taken is not self-occupied, it is rented, then no maximum limit for tax deduction has been prescribed, and the taxpayer can take the deduction of the whole interest amount. Of the whole interest amount. Okay. All right. Next. In the case of a joint home loan, which of the following statements are correct? Tax benefits are divided among the owners in proportion to their ownership share. Each co-applicant can claim a maximum rebate of 1.5 lakhs. Only one co-applicant can claim the tax benefits. The property must be in the joint names of the borrowers. D, 2, 3, and 4. Only one co-applicant can claim the tax benefits. Is it? Only one co-applicant can claim the tax benefits. The correct answer will be B. 1, 2, and 4. 1, 2, and 4. You have to eliminate the third statement, right? You have to eliminate the third statement, so only 1, 2, and 4 is correct. Huh, so that is why the third statement will be incorrect. Okay, all right. Hmm. Now, this unit is also done. Now we come to the mortgage advice. First point we have already covered in a previous question. Mortgage advice business in India is carried out without any regulation. There is no entry barrier, no code of conduct, no ethics to be stipulated. Any person can enter the profession and provide advice and do business. All right. If we are talking about the home information packs, it is there in the US, UK, but not in India. Now, first we have the time value of money, interest and annuities. Two points are covered here, compounding and discounting. We are referring to the future value of money. All right. So if I am saying what will be the value of this rupee 1 after 10 years, what I'm doing, I am compounding. Or if I'm saying what will be the value, what is the value of rupee 1 in the future, let's say I'm going to invest and the scheme says that it will generate 20,000 rupees for me. So what will be the value of that investment in today's time? So what I'm doing, I am discounting. Right, so the process of converting future sums into the present equivalent is known as discounting. The value will go down, right? And compounding is used to determine the future value of present cash flow. So if I'm investing rupees 100 today, it will get compounded in the future. So what will be the future value of this rupees 100? It can be rupees 500. Or if a scheme says that it will generate rupees 500 for me in the future, what is the present value of it? So I'm saying I am discounting. So just need to remember the two definitions. What is compounding? Determining the future value of present cash flows, that is compounding, and determining the future sums, converting the future sums into the present equivalents. All right, these 2 points are there. Then we have the rule of 72, 115 and 144. Now we are doing what? We are compounding. We will determine the number of years before your money becomes almost double, triple and four times. So what will I do? I will divide the number by 72 to check in how many years this money will become two times or double. I will divide the number by 115 to see in how many years it will become three times, and divide the number by 144 to determine in how many years it will become what? It will become four times. So divide the number by 72, 115 and 144 by the percentage rate that you are paying on your debt or earning on your investment. So divide the rate of interest by 72. So it will give the years during which the money will double, triple, or become four times. So let's say I have borrowed 1000 rupees at 6% interest. I have borrowed 1000 rupees at 6% interest. Divide the number 72 divided by 6. So not 6 divided by 72, but 72 divided by 6. Divide the number 72 by the interest rate. So 72 divided by 6 will give me what? It will give me 12. So it will take 12 years to double this amount of rupees 1000. So 1000 rupees will become 2000 in 12 years. Similarly, if I want to see when will it become three times, so what will I do? I will divide 115 by 6. Then what will I get? Dividing 115 by 6. Around 19 years. Yes. So in 19 years, it will become 3000. And similarly, if I want to see when will it become 4000, so I will divide 144 by 6. Huh, correct. I will divide 144 by 6 and it will give me 24 years. So in 24 years, it will become 4000 rupees. Okay. So divide this number by the rate of interest to determine in how many years it will become double, triple or four times. All right. That is how we calculate that is how we use the rule of 72, 115 and 144. Then calculating, there's also another formula for the future value, but that is not important. Now we come to the last important topic from our module E, which is the capital gains. Till here, everything is clear? All the topics that we have covered so far are clear? Yes? Okay. Hmm. So what is capital gains? If I am selling a immovable property, any immovable property, or even a movable property, and I am generating profit on it, so that is a capital gains. So any profit or gain from the transfer of a capital asset is chargeable to a tax under the heads of capital gains. For example, if I own a house and I'm selling it after, let's say, 5 years, the value of the house when I purchased it in 2020 was, let's say, 90 lakh rupees. I'm selling it off in 2026 at, let's say, rupees 1 crore. So the difference between the two, I have to pay tax on this profit. On this 10 lakh rupees, I will pay tax. So transfer in relation to capital asset includes a sale, exchange of an asset, but some things, some assets are excluded from the definition of capital assets. For example, stock in trade, stores or raw material, bonds, securities, personal effects like any other personally owned, except jewelry, archaeological collections, agricultural land, which is not a land situated within the jurisdiction of a municipality within the range of 2 kilometers, not that important. This is not that important. Basically, the definition of capital asset is important. Now, if let's say a person gifts his capital asset to another person, then no capital gain will arise. If I'm receiving a gift, if I'm receiving a house in inheritance from my mother or my father, that will not be included in capital gains. If, however, I sell the house later on, then it will be treated as a capital gains. All right, so if a person gifts his capital asset to another person, no capital gains will arise in the hands of the person who is giving the gift. If let's say the person receiving the capital asset by the way of gift or will subsequently transfers such asset, then capital gain will arise in his hand. So the capital gain, I will have to pay the tax, not my parents. All right. So the cost of acquisition of the capital asset will be the cost of acquisition to the previous owner. The period of holding of the capital asset will be computed from the date of acquisition for the capital asset by the previous owner. So if let's say I'm talking about the inherited house, then what will be the price? I have not paid a price, but my parents had paid a price for the acquisition of the house. So what price did they pay? Time when did they acquire the property? This will be taken into consideration. Now we have the short term capital gain and the long term capital gain. Short term capital asset means an asset which is held for 36 months, less than 36 months. Now this 36 months has been reduced, right? Earlier when we were talking about immovable property, we were saying that 36 months, but now we say 24 months. So in respect of certain assets which are listed in a recognized stock exchange, all of these 3 points are important. Which of the following will be considered as a short term capital asset? All right. So shares which are listed in a recognized stock exchange, units of equity oriented mutual fund, listed securities like debentures and government securities, units of UTI, zero coupon bonds, the period of holding is considered 12 months. So for these assets, the period for holding is considered 12 months. So if you are holding these assets for less than 12 months, it is a short-term capital asset. And after 12 months, if you are selling it, it will be known as a short-term capital gain. So this is the listed shares. What about unlisted shares in a company? Period is 24 months and immovable property is also 24 months. So the shares, unlisted shares of a company and immovable property less than 24 months, short-term capital asset. Listed shares on a recognized stock exchange, UTI units, zero coupon bonds less than 12 months, again short-term capital asset. More than that will become a long-term capital asset. All right. So the short-term capital gain is considered a gain from selling the property which was held by an assessee not more than 24 months. In case of the listed shares, not more than 12 months. He will be liable to pay taxes on the short-term capital gain, and the liability will be significantly high if the assessee falls in the higher income slab. All right. The assessee is also allowed to reduce the sale consideration for any brokerage. They're allowed to deduct any expenditure on the construction and home improvement. However, adjustment for inflation is not allowed. Adjustment for inflation is allowed in the long term capital gain, not in the short term capital gain. Also, no exemption is allowed on the short term capital gain by reinvestment, which is again allowed in the long term capital gain. So, there are various sections under which, if you let's say, um, the long term capital gain arising on the transfer of any capital asset, you reinvest it in the bonds of NHAI or RECL. You can claim the deductions under section 54 EC. Similarly, if let's say any residential housing property, you can reinvest it in another residential housing property. You can claim a deduction, but that is there in the long term capital gain. In the short term, no exceptions or savings is allowed. Then what is long term capital gain? More than 24 months. If I'm holding the unlisted shares of a company more than 24 months, then I'm selling. If I'm holding an immovable property more than 24 months, then I'm selling. Or if I'm holding the assets like listed shares of a company, everything else, UTI, units of UTI, zero coupon bonds, debentures, government securities, every listed security less than 24 months. Sorry, more than 24 months. All right. So where the holding of this property asset is more than 12 months or 24 months and then it is sold off, then it is a capital asset. Less than 12 months or 24 months, then it is sold off, it is a short-term capital asset. And the cost inflation index, adjusting the inflationary rise in the value of asset, is allowed only in the long term capital asset, not in the short term capital asset. So, what will we consider? We will consider the year of acquisition or the improvement, the year of done, the we have already practiced the numerical part on this thing. We will also do more numericals on this formula tomorrow. Right now, let us finish our theoretical part. Okay. Then there is the section 54F. What is the section 54F? Here, in the long term capital gain, what the individual can do, they can use the long term capital gain in reinvesting it to another housing property, right? And I can claim deductions under section 54. So for this, the taxpayer should purchase another house within a period of 1 year or 2 years after the date of transfer of the old house Or if they are constructing, then the construction should be done within a period of 3 years of transfer. So if this is fulfilled, I can claim deduction under section 54. However, if till the date of filing of the return of income, let's say the the proceeds, the capital gains are not utilized to purchase or construct any other house, do I still have an option? So yes, the benefit of the exemption can be availed by depositing the unutilized amount in the capital gains deposit account scheme. All right, there's the capital gains deposit account scheme. And then the new house can be purchased or constructed by withdrawing the amount within the specified time limit, like 2 years or 3 years. Right? So for the purchase of the house, 2 years is there, and for the construction, 3 years is there. If I'm not able to purchase or construct the house, if I'm, let's say, not present in India, or I'm not in the clear mindset to purchase a house right now, I will deposit it in the capital gains deposit account scheme, and then I will use the money to purchase or construct the house. All right. Then the last topic from our module E, it is the topic of reverse mortgage. We already know what is a mortgage. We take a loan from the bank and we pay installments and the principals, the EMI. In the reverse mortgage scheme, what happens? Complete opposite. Complete opposite. All right. So, in a normal housing loan, where the property being purchased is mortgaged to the lender, the borrower avails a loan to begin with, and at that point of time, his stake in the property purchase is low. Let's say I'm purchasing a house, and that house is kept as mortgage. So in the beginning, when I start with the EMI payments, my stake in the property will be low. But as my EMI payments are done and I move towards the complete payment, my stake in the property increases. And once the complete payment is done, I will now get the ownership. So as the regular EMI is paid on the due dates, the loan amount reduces, stake in the property increases. This is a normal mortgage. What happens in a reverse mortgage? The position is exactly the reverse. Under the reverse mortgage loan, the borrower initially retains a high stake in his property and receives a regular cash flow. So here the borrower is going to receive a regular cash flow. Over time, when the loan amount increases, his stake on the property reduces. So this is a scheme for those individuals, let's say, who are retirees or pension, who take pension, Indian citizens above 60 years of age. So what they're doing, they have the stake in the property and they are receiving some payment from the lender or the creditor, the bank. All right. And the loan amount keeps on increasing. So their stake in the property as the time passes by will reduce. So the institute can ask you which of the following statements are true about a mortgage and a reverse mortgage. So you need to remember these points. In a mortgage, as the loan amount reduces, the stake in the property increases. In a reverse mortgage, initially the borrower retains a high stake, but when the loan amount increases, his stake in the property reduces. So this scheme was introduced in 2007. Many banks have already issued these guidelines. It is a scheme developed by the National Housing Bank to help the senior citizens to avail periodic payments from a lender against the mortgage of her or his own house. They are the owner and the occupant. They do not transfer the physical possession. They have the possession. They are the owner. Just they are taking a loan. All right. The borrowers are not required to service the loan during the lifetime. They do not make any monthly repayments. They receive the regular periodic payments. All right. So these are extended by the primary lending institutions such as scheduled banks and the housing finance companies. So any Indian citizen above 60 years of age, married couples will also be eligible as joint borrowers, right? One of them should be 60 years of age, another not below 55 years, should be owner of the residential property located in India. The house or the flat should be located where? In India. That is the reverse mortgage conditions. It should be free from any encumbrances. The residual life of the property should be at least 20 years. They are living here as the permanent residents, and the commercial property is not eligible. Only when they are themselves living in the property, then it is eligible. Now, last few questions for module E, and then we will start with our module A. Which statements are true regarding the tax deductions for interest on loans against commercial property or personal needs? Interest can be fully claimed as a deduction from income from rent, business, or profession. Principal repayment benefit is available. Interest on unpaid interest is deductible. Deductions apply to individuals, HUFs, partnership firms, companies, and other persons as well. D. Others also please answer. I know you are tired. After these questions, we will take a 10 to 15 minutes break. And then we will start with our next module. So interest can be fully claimed as a deduction from income from rent, business, or profession, correct? Principal repayment benefit is available? No. Principal repayment is not allowed. The question itself says deduction for interest on the loan. So second statement is incorrect. Then the third statement says interest on unpaid interest is deductible? No. And it applies to all of these persons. So the correct answer is D, 1 and 4 only. All right. How is the skip this question. This is not important. Okay. What does the concept of time value of money imply? What does the concept of time value of money imply? A rupee received in future is worth more than a rupee received today. A rupee received today is worth more than a rupee received in the future. The value of money remains constant. Investing money today will yield no additional future value. B. Yes, a rupee received today is worth more than a rupee received in the future. Why? Because of inflation and the compounding effect, the value will go down. Yes, the correct answer is B. Great. Hmm. All right. How does the frequency of compounding affect the final principle of an investment? Frequency of compounding. Higher frequency of compounding leads to lower final principal. Annual compounding results in the highest final principal. Increasing the compounding frequency increases the final principal, or the frequency of compounding has no impact on the final principal. How does the frequency affect? C. Increasing the compounding frequency increases the final principal. Yes. If we increase the number of times that we are compounding, if we are compounding only annually, so the value will be low. If we are compounding it quarterly or even more than that, it will increase the final principal. C is correct. No, not B, but C. Okay. Using the rule 72. How many years will it take for an investment to double at an annual interest rate of 6%? Any principal, any investment to become double at an interest of 6%, how many years will it take? 12 years, 6 years, 18 years, 72 years? Correct. 12 years. So simply divide it by 6, we have 12. All right. What is the effect of discounting on the future cash flows? It increases the future value of the cash flows. It calculates the future value of the current investments. It determines the present value of the future cash flows. It has no effect on the value of the future cash flows. Now answer this question. The meaning of discounting. C, yes. Correct. It determines the present value of the future cash flows. To calculate the future value of the current investments, we will be using compounding. Compounding. No, not B. This is compounding. To calculate the future value of current investments, this is compounding. All right. According to the rule of 115, how long will it take for an investment earning 5% interest per annum to triple in value? Triple in value. 23 years, 15 years, 20 years, or 30 years? A, 23 years. Yes, simply divide 115 by 5. So we have, no, not 30 years, we have 23 years. The correct answer is A. Yes, A. Okay. Next, how does the interest rate affect the future value of an investment? A higher interest rate leads to a lower future value. The future value is independent of the interest rate. Higher interest rate result in a higher future value. The interest rate only affects the future value for the short-term investments. Quickly answer. C. Correct. If I have a higher interest rate, it will result in a higher future value. All right. Okay. In the case of compulsory acquisition of an asset, how is it treated for capital gains tax purposes? It is exempted from the capital gains tax. It is considered as a transfer and can lead to capital gains. It is not considered as a transfer. Only the compensation received is taxable. So when we are talking about transfer, then transfer in relation to capital asset will mean a sale, exchange, or relinquishment of the asset, extinguishing of any rights, compulsory acquisition of the asset, conversion of the capital asset into a stock in trade, maturity or redemption of a zero coupon bond, allowing the possession of immovable property to the buyer. Any transaction basically that has the effect of transferring an asset or the immovable property into another person's hands, except of gift and will. All right, so a compulsory acquisition of asset is also considered a transfer and it can lead to capital gains. So it is B. Compulsory acquisition, basically when the government takes the possession of any private property, land for their public use, even if the property owner does not want to sell. So let's say if the government wants to construct a national highway, and the property, the land which is situated in the vicinity of the national highway is to be taken into the construction, right? So even if the owners of the land, they do not want to give the property, they will have to compulsorily give the possession to the government. All right. So the power of the government to take the private property land for the public use. And here it will be considered as a capital gains. All right. For which of the following assets is the period of holding considered as 24 months for it to be a long-term capital asset? Listed shares in a recognized stock exchange, unlisted shares in a company, units of equity-oriented mutual funds, immovable property. So which of this property, if held for more than 24 months, will be considered as a long-term capital asset? Long-term capital asset. Two options are same. Make option B 2 and 3. This is 2 and 3, or rather 1 and 3. 1 and 3. 1, 2 and 3, 1 and 3, 1, 2, 3 and 4, or 2 and 4. Now answer. So we said that any shares in a listed on a stock exchange, what is the period? Or unlisted shares or the units of equity oriented mutual funds, these are held for 12 months, right? Held for 12 months. Listed shares in a recognized stock exchange, again 12 months, right? But unlisted shares in a company, 24 months, and immovable property, 24 months. So the correct answer is D. C is 2, 3, and 4. No, only unlisted shares in a company and immovable property, the time period is 24 months. For everything else, it is 12 months. So, not C, 2 and 4 only. Go through the list again, go through the explanation again. Do not get confused here. This is a very important topic. The difference between long term and short term capital assets. All right. What is the condition for claiming the exception under section 54F? Ignore this. Hmm. What should a taxpayer do if the capital gain from the sale of a house property is not fully utilized in purchasing or constructing a new house by the return filing due date? Forfeit the remaining capital gain, pay capital gains tax on the unutilized amount, deposit the unutilized amount in the capital gains account scheme, carry forward the unutilized amount to the next financial year. Yes, C. C is correct. Right. So if I want to claim deductions under section 54, I need to do what? Either I will have to purchase a new property in 2 years from the sale of the older residential property, or if I'm constructing, then within 3 years. If let's say I was not able to do that, then I will deposit this unutilized amount in the capital gains account scheme. And then 2 years or 3 years, as per the case may be, I can invest my money and claim the deductions. No, not D, C. All right. Okay. What are some key features of the reverse mortgage loan scheme in India? It was introduced in 2007 and applicable from April 2008. It requires borrowers to make regular repayments of principal and interest. It is available for the commercial properties. Borrowers do not have to service the loan during their lifetime. Hmm. So, which statements are correct about the reverse mortgage? C, C, yes. C, 1 and 4. The borrowers do not have to make regular payments, they receive periodic payments, and it is not available for commercial properties, only residential. So, senior citizens above the age of 60 years can invest in the reverse mortgage loan scheme. In the beginning, their stake will be high in the property, and as they receive the payment, the loan amount increases, the stake in the property will go down. All right. What criteria are typically used by the lenders to determine the eligibility for a home loan? Preferred age group and minimum salary or income level, credit score in the credit information report, number of dependents and marital status of the applicant, specified areas or localities for the loan provision. So, what criteria is used by the lenders? C, D, 1, 3, and 4. C is 2, 3, and 4. So the correct answer is D, 1, 2, and 4. The number of dependents and marital status of the applicant, this won't matter. Right? So third statement is incorrect. Preferred age group, why? If you are in the salaried earning group, you're earning salary, then it is better. If you're close to the retirement, the bank would be a little hesitant. Credit score is important, and the specified areas, it should be RERA approved. It should be an approved building or construction. It should not be anything illegal. Right? So D. What is the criteria for service eligibility when applying for a home loan for the salaried individuals? Minimum years of service in the current organization, total years of professional experience, current job title and responsibilities, employer's reputation and market standing. So, what is the eligibility considered by banks for salaried individuals? A, A is correct, right? The minimum service. Total years, current job, employer's reputation, not important. A is correct, right? Okay. Hmm. A. Next, which of the following is not a key legal and valuation detail considered in the home loan process? Date and advocate's opinion on the title of the property, date of valuation and value of the property as per the valuer's report, whether the property is encumbered and details of any existing loan, the historical significance of the property and the previous owners. Which of the following is not a key legal and valuation detail? Yes. The historical significance of the property and the previous owners, this is irrelevant, right? This is irrelevant. So D. Hmm. Okay. What is the typical duration of a repay holiday moratorium for a home loan? Up to 18 months after the first disbursement or 2 months after completion of construction, a maximum holiday period of 3 months for the purchase of land with building or flat, 6 months after the purchase of property, the entire duration of the construction period. Ah, this question we have done so many times in different forms. So A, 1 and 2. Last question, which statements are true about the features of a simple mortgage? The mortgagee has no power to sell the property without the intervention of the court. The mortgagee is entitled to payments out of the rents and produce of the mortgaged property. The mortgagee is not put in possession of the property. Registration is mandatory if the principal amount secured is rupees 100 and above. Which of the following statements are true? You need to answer which of the following statements are true. Is the mortgagee entitled to the payments out of rents and produce of the mortgaged property? Is it? No. Yes. So the correct answer becomes D. You need to eliminate this statement. No, they're not allowed. In a simple mortgage, they're not allowed. They're allowed in the usufructuary mortgage. Usufructuary mortgage. Yes. So second statement is incorrect. All the others are true. They do not deliver the possession. They bind themselves personally to make the payment, and there is no power to sell the property without the intervention of the court. And that is all. We are done with module E. Now tell me, do you want me to continue or shall we take a 5 minutes break and then start with our module A? Or shall we continue? We have already on our first day done questions from module A, so it won't be tough to cover this module. E we had not done, so that is why it took a little time. 5 minutes break, okay. Okay, all right. So we will start again at 8:20. All right. 5 minutes done. Are we here? Are you guys back? Drop a message. Ready? Okay. Others also, please respond that you're here. You are here. Great. All right. So I think we'll be able to do a part of module A today. Let us start. Let us see how far we can get. Okay. Module A, again, a very small unit, very simple unit. Only 4 to 5 important topics are here that we are going to cover very easily. All right. First, if we revise the meaning of retail banking, offering the banking products and services to the individual customer. Now, individual customer also includes the small businesses, MSMEs also. Do not get confused with the corporate, right? So, retail banking involves two stages: mass retail banking and then class retail banking. In the mass retail banking, we offer the same product with more or less the same qualities to all our customers, to the broad customer segment, right? So, standardized banking products and services to its customers, building a sufficiently broad customer base that will serve as a stable source of income. Then, once these customers are onboarded, then we enter into the class retail banking. So, now here the bank offers the customized products and services to the high net worth income group, to the niche customer segment, high net worth, and this is also known as private banking. So once we have identified the customers that are more profitable, we will try to provide them tailor-made services, particularly catering their demand. So personalized, starting from mass retail banking and then class retail banking. What are the advantages of retail banking? Client base will be large and therefore risk will be more widespread. Customer loyalty will also be strong. There will be a good scope for cross selling. If a customer is already availing a home loan and they need to take a second housing loan, they will take it from the same bank because they trust the bank. Attractive and wide interest spread because the customers cannot bargain, right? There is a wide customer base. They cannot bargain for lower interest rate on the loans and higher interest rate on the deposits. The credit risk also tends to be well diversified because the ticket size of the loan amounts is relatively small. So even if a certain percentage of the customers they default, the loan amount being very less, it will not impact the bank's health, financial health. All right. Now answer these questions. Retail banking evolves from mass retail banking to class retail banking. What distinguishes these stages? Mass retail banking focuses on the standardized products for a broad customer base. Class retail banking is exclusively digital banking. Mass retail banking primarily serves the high net worth individuals. Class retail banking offers customized services to the niche customer segment. Which of the following statements are correct? Yes, what will be the correct answer? C, 1 and 4. Mass retail banking serves the mass customer segment, and class retail banking serves the high net worth individuals. So the correct option is C, 1 and 4. C, yes. All right. How does retail banking differ in its approach? to customer service compared to corporate banking. Retail banking exclusively uses the digital channels for customer interaction. It targets individual consumers and small organizations. Retail banking does not offer services like mortgage. It focuses on a small number of clients with high value transactions. So, how is retail banking different from corporate banking in its approach? Yes, what will be the correct answer? Quickly, quickly. Very simple question. Huh. The correct answer is B, right? The target of retail banking is individual consumers and the small organizations. If you do not understand any point, any concept, please ask me. I am believing here that we have already covered these questions and concepts in our first day of the MCQ discussion, so you already know these things. We are just revising, recalling everything. All right? Huh, so the correct answer is B. Okay. Which factors contribute to the attractiveness of retail banking? High volatility in demand and credit cycle, wide interest spreads due to fragmented customer bargaining power, ability to categorize and select clients using the scoring systems and data mining, high transaction costs due to maintaining extensive branch network. So you need to answer factors that contribute to the attractiveness. Why banks prefer retail banking, that you need to answer. So you need to answer the positive things, not the negative. How is it attractive? A. High volatility in demand and credit cycle. If there will be high volatility, then it will lead to lower profit for the banks. High volatility means sometimes the demand for credit and the banking products will be high, other times it will be low. Stable income is not there. So one is incorrect. What else? Other also try. One is not correct. A option is not true. Huh. Now you got it right. So the correct answer is D. 2 and 3. There are high transaction costs due to maintaining extensive branch networks, but this is not a positive factor, this is a negative factor. Although true, but a negative factor. Okay. What characterizes the liabilities and asset side of retail banking? Assets are characterized by high value corporate loans. Liabilities include large number of retail deposits. Assets include lending to numerous customers with small ticket size. Liabilities are primarily composed of investments in capital market. C, yes, the correct answer is C, 2 and 3. Assets are characterized by low value, low ticket size retail loans. And liabilities are primarily composed of investments in capital market. No. Liabilities are the deposits. The deposits, the demand deposits, fixed deposits, these are the liabilities. Okay. Yes, C is correct. Next, what risks are particularly associated with retail banking products like unsecured loans and credit cards? What risks are involved? High delinquency rates, especially in unsecured loans, lower delinquency rates compared to secured loans, minimal risk of unhealthy competition among banks, lack of need for robust IT systems for client management. A. Hmm. Because they're unsecured in nature, so there are high delinquency rates. High delinquency rates. Correct? Okay. What catalyzed the evolution of retail banking in India? What has, we will say, influenced or motivated the banks to take retail banking? The consistent approach of public sector banks to banking, the introduction of consumer banking models by the foreign banks, the reluctance of Indian banks to adopt new technologies, the entry of new generation private sector banks in the early 1990s. So, which statements are correct? Which statements are correct? C is 2 and 3. Reluctance of Indian banks to adopt new technology. If they were reluctant to adopt new technologies, would retail banking have worked? Retail banking depends a lot on technology, right? Multiple channels of distribution. So, third statement cannot be true. Then A. Again, third statement cannot be true. The correct answer is B. The correct answer is B. Yes. Consumer banking models were introduced by foreign banks in India and the new generation private sector banks in the early 1990s. So the correct answer will be B. Indian banks' reluctance is not the correct statement, and public sector banks, they did not have a consistent approach. They went with the corporate banking seeing profit, that this sector is generating profit, so we will offer the services to the business class only. All right? Okay. Let us do one more topic and then we will end the session. So now we are talking about the business models of retail banks in India or banks in general in India. So we have three types of business models: SBU approach, departmental approach, and integrated approach. Again, we have studied about it in detail. SBU approach, what we are doing, we are dividing the business lines of the SBU. So what we are doing, we are creating profit centers. Profit centers. One whole business is divided into separate strategic business unit, right? So each of this SBU is a profit center. They have their own product to focus on. They will determine their own price, strategy, their own promotion and advertisement, everything. So what we are doing, we are dividing the business on the lines of SBU. These are characteristics of SBU you need to remember. These are independent divisions, autonomous divisions, small enough to be flexible and large enough to exercise control over most of the factors affecting its long-term performance. So SBUs are profit centers. They focus on product offering and the market segment, only on the product that they bring to the market. It can be a business unit of a large corporation or it can be a business in itself. All right, so these are the features of SBU. In the new generation private sector banks, the business model is very clear. They have adopted the SBU. In today's time, some top public sector banks are also adopting the SBU model. But mostly the public sector banks, they go with the departmental approach, right? So there is a well-defined business focus even in the foreign sector banks. So what we are doing in the SBU, we are following a management by objective process, right? So we have targeted profits, we have the strategy to achieve those profits, and let's say if the plans are not translated, they do not generate the target, then we will shut down the segment. That is the SBU. Strategic business unit, separate profit centers, followed by new generation private sector banks and the foreign banks as well. Second approach is the departmental approach. Now we will not create separate profit centers. We will divide the business on the functions that each department or the team performs. So rather than dividing on the strategic or business lines, an organization can be divided on the basis of functions that the various teams perform. So the departmental approach is a specialized functional approach within an organization. SBU is separate from the organization. Departmental approach is within the organization. So there are various departments and teams. We have the accounting department, marketing department, finance department, planning department. They will perform their functions. Each of the department will be independent. They will have their own chain of command. They will have their own management, right? So we are not following any profit targets. We are working for the whole organization. Every department has its manager and chain of command as well. Public sector banks have adopted a departmental approach, right? They're not creating separate units, business units. What they're doing in a unified business, they are creating departments. So it is a more general approach. Retail banking is one of the business models and not a focused business model. In the SBU, retail banking will be a focused business model. In the departmental approach, retail banking will be one of the business models, not a separate business model, right? In old generation private sector banks also, they go with retail banking as a part of the overall business. They do not do it separately as a profit center. All right. This is the case of the old generation private banks. And then finally, we have the integrated approach, which is a unified approach. So it is adopted by the smaller businesses. They combine all the socio-economic aspects and adopt a cohesive approach to tackle the problems. They assume that having a unified business would reduce the risk, increase the profitability, right? So they're not going with SBU, they're not going with department. They're not creating separate departments. Even if the departments are there, they're not independent. They are interdependent, working as a whole. All right. So, yes, banks they structure their models may, based on their positioning platform. Basically, it depends how or what importance they are giving to a particular business model. In the old generation private banks, positioning platform is clear. It is based on the overall business plan in line with the size and scale, whether they want to grow themselves as a large scale retail bank or a large scale corporate bank. A very clear positioning strategy is followed by the old generation private banks. In the new generation private banks, they also have a clear vision, but their vision is related to profit. They want to be top in all the classes. The old generation private banks, they select a type of business and they focus on it. The new generation private banks, they want to focus on all the classes and they want to be on top, right? So they have clear positioning strategies where they want to be going forward in the next 2 or 3 years, and they put suitable action plan to achieve their objectives. They're very, yes, they're aggressive. They have aggressive positioning and they have technology, strategy, customer, and business initiatives. Foreign banks, they do not go by positioning objective, they go by business objective. If they see that this particular segment is profitable, they will enter the market, and if they see that it is not profitable, they will exit the market. They will exit the segment or entire business line within the model. For example, BNP Paribas, they entered the retail banking space very aggressively, but they quit because it was not profitable. American Express Bank, they also came out of the retail, their credit card business. Citibank have also quit their retail business. They have not completely stopped their banking activities. The particular segment, business segment, they have quit. Now let us answer last few questions related to these topics and then we will stop. All right? Okay. What characterizes the SBU approach in banking? SBU operate without any autonomy in decision making. They are profit centers focusing on specific product offering and market segments. Each SBU lacks control over factors affecting its long term performance. SBUs function as autonomous divisions within the banking institution. Quickly answer this question. What will be the correct answer? D. Yes. 2 and 4. They are autonomous divisions. They are small enough to be flexible, large enough to exercise control over all the factors affecting its long term performance. Yes, D is correct. All right. When an organization is divided on the basis of functions the various teams perform, then such an approach is known as SBU, departmental, functional, or integrated. What do we call this approach when the organization is divided on the basis of functions? Departmental approach. Yes. On the basis of profit, SBU. On the basis of functions that each team performs, departmental. All right. How do the retail banking models vary among the different types of banks? They are the same for all the types of banks, public, private, and foreign. Only the public sector banks adopt distinct retail banking products. Foreign banks do not have specific models for retail banking. There's variation among the all the types of banks. So what is correct? D. Hmm. Correct. There are variations. Public sector banks, they go with department. Private sector banks, SBU. Foreign sector banks also follow SBU, but mostly profit motive. All right. What is the significance of departmental approach in the context of retail banking? It emphasizes separation of retail banking from other business functions. It integrates retail banking into a broader organizational structure and functions. Retail banking is given less importance. It leads to lack of specialized management. How does a departmental approach work? Departmental approach emphasizes the separation of retail banking from other business functions. We are talking about the departmental approach. Yes, it integrates the retail banking into a broader organizational structure and functions. Correct. The correct answer should be B. B. Last question for today. Last question. How do foreign banks typically structure their retail banking models? Based on long term positioning objectives, focused on customer business and profit targets, committed to maintaining presence in all segments, ready to exit segments, or entire model if not profitable. So, what will be the correct answer? Foreign banks? Yes, the correct answer will be B. B. Hmm. All right, then. So, that is all for today. We are done. although we are halfway through the module A, but we will cover it tomorrow. All right, it is enough for today, otherwise, we will get tired. All right, so tomorrow again at 6 p.m. we are going to have the marathon session, and this time the marathon will go till 11 p.m. on the YouTube itself. 11, 11:30, whatever. We will take 10-15 minutes breaks in between after each module, but we will cover all the four modules. We are done with module E. We will cover all the four modules, theory plus MCQs. All right, then I am ending the session now, and in 15 minutes, I will see you in the capsule batch on the app of Oliveboard. Before you leave, please like the session, share the session, and I will meet you tomorrow at 6 p.m. All right. Thank you so much, and